device or something. Working on orientation. What does this one look like? You change the positioning. That's okay. That's okay. So welcome guys. Welcome guys. We are looking at money market funds. Questions relating to money market funds. And question number one, we will look at the money market fund itself. And as it says, one, we have to look at what a market is. And a market would be a designated place or platform where you find buyers and sellers, issuers and purchasers. In the point of a money market, we are looking at savers and borrowers or entrepreneurs, companies that are looking for capital, that companies that want additional capital, especially debt capital or equity capital, and we will have the investors. In a money market environment, the money market fund manager or the investment bank or the company acts as an intermediary. It links the issuers or the companies, corporates that are looking for capital with the savers or investors. A fund is an accumulation. A fund is a pool of money that is sourced from different people. And in the category of a money market fund, in most cases, it will be a pool of resources, money, from retail investors and other investors. The word retail investor refers to an investor who doesn't meet a certain threshold. The benchmarked market that gives us the threshold is the treasury bill market or the bond market. The treasury bills and bonds issued by the government. When you look at treasury bills, the minimum amount that is required for one to invest directly or purchase IOU instrument from the government is 100,000. Bonds, it's at 50,000. So categorically, we can talk of a minimum amount of 50,000 shillings. There are many investors, beginners, who cannot raise that amount at once. Such individuals access the market through intermediaries such as the fund managers who are operating the money market funds. Therefore, when you are investing in a money market fund environment, it categorically means that you are not purchasing a product. What you are purchasing or what you are getting is a service by an individual who accesses the market, the primary market directly. And that is the reason why we don't talk of capital gains in a money market fund environment. You are accessing the market via another person. So the pooled funds or the fund being invested by the fund manager will give you a service and not the bond, if it is a treasury bond that is being purchased, a bill, if it is a treasury bill that is being purchased, or the commercial papers issued by corporate companies. What you'll have purchased is a service from the fund manager. Another good question relating to money market fund is, how are management fees charged? Locally charging of management fees is regulated by the Capital Markets Authority, and it is pegged at a maximum of 2% of the capital, the amount that you are investing, not a 2% of the interest or the returns that you get from the fund investment. And because it's a percentage of the capital that you pay, and this is the annuated rate, it's a 2% per annum. And therefore, the management fee will be spread or staggered over a period that you are going to be investment. Remember, money market funds, the amounts are accessible by the investors at will. So these are short call investments. And for that reason then, the management fee will be spread. Yes, Omar, I can see you. Omar Ramos, hi. Thank you for joining. Thank you for joining. If you're liking the content, you can subscribe to the channel. We'll appreciate. So the amount that you put in as an investment forms the object to which the rate, the management fee rate will be subjected, and the resultant amount will be spread throughout the year, and it shall be deducted from the returns that you receive. And therefore, the amount of interest that is reflected, the amount of interest or the rate of interest that is shown by the fund is exclusive, does not include the management fee rate, but it does include any taxes that are relevant to that investment. And in this case, it's a 15% withheld tax, which is not final tax. And that means at the end of the year or the period, then you'll have to account. You'll have to account for the taxes through your filing of returns. Another question I've received is a question on the turnaround time. Turnaround time on withdrawal from the money market funds. And turnaround time will refer to the number of days or time it takes from the time you request or issue a notice of withdrawal to when you receive your money from the fund. And there are several factors that will come into play in determining the turnaround time. One, it will be indicated through the fund fact sheet. A fund fact sheet is a catalog. It's a catalog that shows or details about the fund, and in most cases it also shows the assets or the investments that the fund manager is allowed to put the fund money into. And therefore, the fact sheet will specify the number of days it shall take for specific types of withdrawals. Types could depend on the amount that you're requesting and the channel that you're using. Because if you request to withdraw via a bank account, if your account sits with the custodian of the fund, then it will be an account transfer, which will be immediate. If the channel that you're using involves a third party, you're transacting from the fund, custodian bank, through a mobile channel, depending on the amount that you're requesting, it might vary out of the threshold that has been given in the fact sheet. And another one would depend on public holidays and weekends, because the number of days that are given for withdrawal turnaround, that is based on business or working days. So if your request comes preceding a public holiday or a weekend, then the days of the public holiday or the weekend will not count, and that increases your turnaround time. Question number 4, how is the fund rate of return benchmarked? And that is one item that as an investor you should be able to identify. That money market funds, by virtue of the fact that they are more or less call accounts because the amounts invested are accessible by the investors at will or on demand. Being short call accounts, then they are benchmarked with the 91-day treasury bill. You will note that in determining rates of return or cost of capital, we look at the period that you invest. We will look at the horizon for that particular investment. For money market funds being short-term investments, if you are investing in a money market fund, identify the rates, the benchmark rate. Is it a 91-day treasury bill? Is it benchmarked with a 181-day treasury bill? Or is it 365-day treasury bill? The longer the duration of investment or the threshold, the horizon of the treasury bill benchmarked with also determines the rate of return for that particular fund. In most cases, majority of money market funds are benchmarked with the 91 treasury bill. Then the next question is, then, how come or why do money market funds pay a return that is equal or sometimes higher than the treasury bill they are benchmarked against? And you note that when you approach the the primary market directly, there are advantages that accrue to accessing investment in the primary market. There are certain advantages that encourage, or they are tailored to encourage, huge big investors. And for instance, in the treasury bills, if you are investing an amount that is more than 20 million or for a long period, then the withholding tax applied on such an investment is reduced by 5%. So instead of 15%, the fund manager will get a withheld tax of 10%. But you, the retail investor, you are going to be taxed at 15%. At 10% and 15%, which leaves in a 5%. Another comes with the economy of scale. When the fund manager approaches the primary market, if it is a fixed deposit or negotiated deposits investment, they are able to negotiate for higher interest rates because of the huge amount that the fund is being invested, as compared to an individual who is putting a small amount of investment. Therefore, these well-negotiated investments give a higher return compared to the treasury bill to which they are benchmarked. And in most cases, the fund manager will promise a rate that is 1 basis higher than, or 100% basis higher than what the treasury bill is paying. So because of the advantages or the savings, the range difference between what the fund is paying out or what it is receiving, that gives a upper hand, and they are able to give a higher rate or a rate equal to the treasury bill rate. Another question: what determines the interest rate? And I think that that question is already answered, that the interest rate is benchmarked with the treasury bill interest rates to determine the minimum amount that should be paid. Another question is, why do some money market funds pay a higher rate compared to others? It's notable that with our list of 29 registered money market funds, that list reflects that the top 5, they pay higher interest compared to at the bottom. But something that you need to look at is those money market funds that are paying a high interest rate, as a return. Majority of them are new in the market, or compared to the money market funds or the fund managers who are paying comparatively lower rates. They are newer and they are managing smaller funds compared to those are paying lower interest rates. And this is the rationale. And the rationale lies on flipping of the investment portfolio turnovers, because the return, the interest rate that is paid out of money market funds fluctuates. It changes over time as the treasury bill rate changes. Remember, these bills or bonds or commercial papers are issued on a short-term basis, 3 months, 6 months, 1 year at most. In periodicity concept in investment, we are looking at a short-term investment period of up to 365 days, that is 1 year. And therefore, the portfolio turnover is when you purchase and that instrument matures, you redeem and repurchase again. The redemption and repurchase, that is a portfolio rotation. Thank you, Omar Ramos. Thank you. Thank you. Thank you for that encouragement. That portfolio rotation will be difficult or not easily achieved by fund managers who are managing huge funds in tunes of 100 billions. They are not able to turn over or flip that entire portfolio into the new bills on issue. But a fund manager who is managing a small fund is able to rotate or flip over or rotate that entire portfolio, catching up with the rates, prevailing rates with the treasury bills. So for that reason, comparatively, that's the reason why the newer managers, the newer money market fund managers pay a higher return compared to others. Another point or another reason is diversity of markets. Some money market funds have access to other markets. When the local markets are shrinking or become bearish, they are able to flip their portfolios in other markets where they are able to get higher returns. I can see Ramos is saying that I'm sure there is a lot of people that love your videos. Thank you, thank you. Yes, I appreciate a lot. I appreciate a lot my 600 subscribers to the channel and how more are coming. So thank you, Ramos. So there's that diversity, availability of other markets. And the other rationale or reason for variation of the interest rates is competition. The fund managers are competing, are sourcing their funds from the same market, local markets. And therefore, they are able, in that effort of competition, they are able to promise or give a higher rate of return in order to attract investors. And that then, that informs the fact that the interest rate that a fund is paying is barely basic. That is a basic promise by the fund managers. There are other factors that are more salient and investors need to look at, not just the rate itself. And that being that, that's the reason we look at some circumstances under which a fund can collapse. Because unlike in most cases, when we are selling this product, we insist that, or we argue out that there are zero risks related to money market funds. But the fact is, there is no investment that is free of risk. Even treasury bills and bonds issued by governments do have a sizable amount of risk. Therefore, for a fund that is an intermediary will suffer risk related to the issuers of the instruments, because if the investor or the issuer of the instrument defaults, in redemption or paying back the amounts that were invested by the fund managers, then automatically the fund loses. And that's why we look at the element of regulation, where it is required in the regulation that the fund manager cannot invest the entire fund into one investment in order to spread that risk. Is the minimum a fund manager can invest is required to have spread the risk up to 4 or quarters or 25%, so that in case an issuer goes down, then the fund does not lose entirely. I have a question from Lebo. Welcome, Lebo. Thank you for the question. A good question. Hello. If I invest, say, 20,000 shillings in a money market fund and 20,000 in treasury bills, which one will be more profitable over the same period of time? I want to assume the 20,000 in a money market fund and the 20,000 in a treasury bill. I want to spread, because I would guide you to the 29 registered fund managers. Out of the 29, we have at least, they rank from the top to bottom, where the top they are issuing at rates that are higher compared to the ones that are ranked at the bottom. So to answer your question specifically, because of objectivity and maximization, we will take an investment from the highest paying money market fund. That fund will always be paying the same return as the government in their treasury bill or slightly higher. Therefore, if you are a small investor, because in this investment, a small investor will be categorized as one who doesn't meet the threshold of taking the advantage of the economy of scale that is given in the primary market. If you look at the treasury bills issuance, if you invest more than 2 million in a bond, that is the time you get a concession on tax. The amount of the rate of withholding tax applied to that investment is less by 5%. Instead of 15%, you save. You are taxed at 10%. Therefore, investing 20,000 in a treasury bill, you are going to get an amount that is more or less the same as what you are going to get from a money market fund. Another thing that you need to look at is the treasury. If you purchase a treasury bill direct in the primary market, and that is presumably true, if you purchase from the primary market, then in the event you want to liquidate or you want to access that money, the process is a bit more complex as compared to a money market fund. I hope, Lebo, you are answered that for this amount of investment, you are going to get more or less the same return. Unfortunately, because of the accessibility within the money market fund, you are likely to destroy the investment, and therefore, in the long run, you may accumulate a lesser amount compared to when you purchase in the primary market because of rigidity. It means that if you are going to go for the treasury bill direct from the primary market, and assuming that could be the only investment that you have, in the event you have an emergency, then you will have to struggle a lot. If you are going to go for the primary market, you need to have an emergency fund in place, because it is a bit problematic to access money directly in the primary market, because you will need to sell that instrument in the secondary market, which would also require the service of a broker. So back to money market fund and the reason, rationale behind paying a rate that is equal or more than what the treasury bills are giving, is on essence of competition. The government, thank you, Lebo, and welcome. I hope you have subscribed. You are subscribed to the channel already. I hope you answered. If you have another question, you can post. The other reason why a money market fund will pay a rate that is equal to what the treasury bills are paying is a question of competition, because both the government and the fund managers are sourcing their funds from us. The fund managers are in business or brokerage business, while the government is in need of capital. So for that reason, the fund managers will tend to give us a rate the same as the government, and owing to the other factors that make the money market fund more attractive, factors of especially liquidity, ease access of that money, quick turnaround times, that gives them an advantage. So competition gives us a high rate comparable to the treasury bills. Another question is why should one consider investing through the money market fund as opposed to approaching this primary market directly? Number one, we look at information. The 3 E's. There's a question of how much are you exposed into these investments? How much information, knowledge, skill do you have? A fund manager and his team will have assembled a team of well-trained, skilled persons with experience in the field of investing and exposure, which majority of our small investors may not have that exposure. Number two is a question of leveraging on time. In most cases, there are decisions are the easiest way you can lose money in investments, quick decisions. And in investment world, one of the things that matter most is your ability and skill to mitigate risks. And when it comes to market adaptation, which is an exposure that lacks in many people, but that may apply to certain markets. Suppose to treasury bills and bonds that are a little bit easy for those who have existing emergency funds, because if you approach the primary market with the absence of an emergency fund, in the event you are faced with a circumstance that requires you access your money or liquidate the investment, that may become a challenge. Another reason why we would go for a money market fund is the fact that when we are not able to raise the minimum amounts that are required to venture directly in the primary market, we will use the money market funds as an avenue to park our money or accumulate capital that can now make us or enable us venture into the primary market. Another reason for using of the money market funds is in the event you do not have an emergency fund, it exposes you to a risk if you're going to approach the primary market directly, because you might be forced circumstantially to dispose of your investment at a discount because of the pressure that comes with emergencies. But if one has, if you have an emergency fund in place, one can hope to go directly in the primary market so long as you are able to raise the required minimum capital. Another rationale for investing via the money market funds is the level of security. You are more secure with the money market fund, and this is a case where we are talking of the commercial papers. If you are to purchase a high OU instrument through private corporate institutions, you are better off in a money market fund because you are safer. your money is guaranteed security as opposed to when you want to approach the market directly. In the case of in investing in private institutions. I have another question here. What is the minimum interest bearing balance? I think this one speaks to mostly the banks, because banks and SACCOs, the traditional banking institutions, many accounts would require you to maintain a certain minimum balance in order for the bank to accrue interest to that account. When it comes to money market funds, the minimum amount of investment or top up, that is what is required for you to start generating your income or earning interest. That personally, and how of experience and what I've done, I like looking at the investment journey in two ways, where we categorically split or identify three different periods in our investment life. There is a period of accumulation that is purely saving. Because at this point, when we are talking about saving, at times, even if you are promised or you are given a high interest rate, and you have saved or accumulated a small amount, then at that point, the amount of interest that you will be paid out may not even reflect in that account. For instance, take an example of a person who is putting in a money market fund that is accumulating minimum of 100 shillings to 500 shillings. If you put in 100 shillings and you are given a rate of return of 20%, which is not in the market, but let's use a high rate of 20%. It means you are going to be paid 2 shillings. And because the rate is annuated, it's an annual rate. If you divide 2 shillings by 365 days, in order for us by following day, because most of these funds, they sell, one of the advantages that makes money market funds attractive is the daily compounding. The 2 shillings divided by 365, if you use a calculator to determine what is supposed to be credited in that account, cannot be rounded off into an amount that can reflect in that account another day. So if you talk of 100 days, that person, if was consistently putting in 100 shillings per day, in 100 days, they will have accumulated 10,000. 10,000 at the same rate of 20%, you are getting a figure of 2,000. 2,000, if you divide by 365, that is the time now it might start reflecting. You might start seeing figures that are rolling. So it means for the first 100 days, if this person his mindset is on the return, the amount of interest, they will easily get discouraged and possibly feel like they are cheated and pull out from that investment. So it's specifically, we need to identify, we need to know when we are in the stage of accumulation or savings, and that is a time where interest, the rate will matter, because at saving stage, we are looking at safety or protection of the cash, the capital that we are accumulating, and also we need to be cushioned against inflation. So long as what we are getting is above the existing inflation rate, we are good. If it surpasses that one, that is the time we are talking of a growth in what we are putting in. But investing stage, your investing stage will come in where you have accumulated sizable capital. You have sizable capital. So that when that amount that you have invested through accumulation over time, the amount reaches 100,000, 200,000, 300,000, a sizable capital. When subjected to that promised rate of return, the amount of interest that you are receiving can actually replace or take care, or maybe a bill or two. That is the stage now we will talk of. You are now at the investing stage. But at the stage whereby the amounts that you are accumulating, the rate is subjected to the rates, the amounts of returns that you are receiving are immaterial when you look at your expenses, because our wealth creation journey is a journey of replacing our active incomes with passive income, our active sources with passive sources. You'll acquire a level of independence. Independence is when we are looking at active incomes. You are independent of time from your active incomes. Your active sources are being replaced by your passive sources. It means it's a way of you maximize on your active sources, build a good fund amount of capital that can generate passive incomes, interest, dividends that are big enough to replace a portion of your active incomes in terms of the expenses. So once you have accumulated a capital and an investment amount that when you are paid your interest, it can sort at least a bill, one of your bills. You have 100,000 and you are getting paid 20% a return, 20,000 in a year. If you split 20,000 in a year, that can translate to 1,500 shillings. That can sort maybe an electricity bill. That's now because you are likely not to hit a jackpot or an investment that sorts all your expenses at once. So you need to adopt an investment journey or pattern that knocks off one bill at a time. At the end of or in over a period of time, you will have replaced many of your bills with passive incomes compared to this. So the other question, I have a question here. What is the minimum locking period in a money market fund? A locking period refers to a fixed period. So this question, I believe, is asking whether do we have a legal fixed period of time over which one should lock their money or invest their money in a market fund, or for how long does it take to invest in market before you start accessing your money via withdrawals. And as per regulations, money market funds should not have locking periods. And therefore, if a fund manager or an investment firm would want to tailor a fund product that will have a locking period, they have to apply to the regulator for that approval. And once the approval is given, that has to be specifically communicated to the investors before they invest. So generally, there are no locking periods in money market funds. But most funds will give an option. If you want to lock your money, you are given that option to lock. If a fund manager would want to tailor a product that has a locking feature, then that has to be approved and should be communicated to the investor before they invest. A problem arises when you use an application, mobile applications, or if you register and invest via online channels, where the fund manager or the investment firm does not have a direct relationship with you as an investor. If you are going to use channels, online channels, if you make a mistake when you are keying in or programming your details on those applications, like for example, if you hit the locking option, once you have accepted the terms and the condition on that channel and you have sent your details and confirmed, for security purposes, you will be limited from editing that information. For security purposes, you will not be allowed to edit. You are supposed to get in touch with the office on the other side, either via email or via telephone call, in order for a change to be effected, because that is an optional. If you choose the option, if you elect to lock your account, then you will not be allowed to make amendments or to change that. You will have to give a notice or a request to the fund manager or the office of the investment firm in order for them to do the edit for you. Another question. I have a question here. It's a question that reads, I have a question, how are money market funds safe? It's a very common question. I think I'm answering this question for I think the 10th time or so. How are money market funds safe? Number one, money market funds are regulated. However, it is your responsibility as an investor to make sure that the money market fund that you want to use as your investment vehicle is regulated. Instances, you may get unregulated funds operating. If you invest your money in an unregulated fund, in the event of anything happening, the regulator cannot help you. But once you have invested in a regulated fund, it is under control of the regulator, and therefore in the event of anything happening, you can access your money via the regulator. The other level of safety to money market funds relates to segregation of functions. There is an investing function, which is a duty or a function assigned to the fund manager. But the fund manager is distanced from the money or the fund itself. The money, the management of the money in the fund is assigned to another institution, which is an established bank, which they call a custodian. Each fund has a custodian, which is a bank that controls and manages the money in that fund. The fund manager sources the investment, and the payments are done by the custodian. When you request for withdrawal, the fund manager relays that information to the custodian, then the custodian is the one who pays you. That is the second segregation. The third segregation, the function of ensuring that the fund manager adheres to the fact sheet, and the custodian does not fall into the trap to collude with the fund manager to put the investment in opportunities that are not specified in the fact sheet, and that is a trustee. The trustee ensures that the interest, your interest as an investor, are always taken into consideration. So at the trustee is another established bank. So up to that point in safety, we have two banks, which means that the only time we can assume and express risk in the money market fund will be talking of two banks collapsing, the custodian and the trustee, which is rare. It's almost impossible to have two banks collapsing at the same time. Then there is a fourth function segregated to the CMA, the Capital Markets Authority, who is the regulator, is the one who checks to ensure that the three, the first institution, the fund manager, the custodian, and the trustee, each of them execute their mandate to the letter, because they are supposed to report to the regulator periodically. actually on quarterly basis. The custodian will report about management of the fund or the cash in the fund. The fund manager reports to the regulator on the asset allocation of that fund to ensure that at least they are spread into 4 categories in the very minimum. And the trustee reports to the regulator on levels of trust, ensuring that the investor interests are taken care of. So in such a case then, when you look at the fund, the money in the fund cannot be reflected in the balance sheets of the custodian or the investment bank or the fund manager books. And therefore, that expresses the level of safety. That is to say, so long as you are putting your money in a regulated, a registered and regulated money market fund, your money is safe. Even if the fund manager or the investment firm collapse, that institution, the fund manager does not collapse with the fund, does not collapse with the investor money. The investor money is safe with the custodian. And what happens is the Capital Markets Authority, as the regulator, in the event a fund manager, the institution collapse, the regulator appoints another fund manager to continue with the investments. And therefore, what you're saying is that money market funds are safe. However, another question, under what circumstances can an investor or can investors lose their money in the fund? Because they are there. Number one is default of the issuers. If the fund manager has invested in the government treasury bills or treasury bills and bonds, and the government default in the redemption or paying, it means that segment or that allocation of investment has failed, as defaulted, and therefore the investors lose the money. Allocation that is assigned to commercial IOUs, corporate bonds issued by private firms, if those companies collapse, the fund will lose money. And that's why as the regulator spreads the allocations to a minimum of 4 or a maximum of 25% of the fund to each particular investment at most, so that in the event a default happens, the fund is not affected. If you look around on the institutions that have collapsed, the recent times, and have gone with investor money, we have Iberian Punk, we had Nakumat Holdings, we had the Chess Bank, and if you look at those institutions and the years in which they collapsed or these institutions were going down, they are sparsely spread. So it's rare, hardly can you lose your money in a money market fund. Another question is, what do money market funds offer? Higher returns or equal to the treasury bills? I think that one we have answered. Why is it that some money market funds are giving an rate of return, interest? They are paying an interest at a rate that is either equal to the treasury bills or more. And just to repeat, for the sake of the question, number one, we have said is competition. The government is competing with the fund managers to source money, because they are sourcing the funds or the money from the same people, we, the investors. And therefore, the fund managers or the money market funds would want to promise a return equal to the government treasury bill, so that they beat them in that competition, and at times they give us a higher rate compared to the government treasury bill. But if you are critical enough, if you are a critical investor and you look at the economy of scale enjoyed by the fund managers, you will understand why the fund managers are able to give us a rate that is equal or slightly higher than the treasury bills. When we say that the funds are invested in well-negotiated near cash instruments, we are looking at the investments in the short term. We have three levels of investment or horizons when it comes to treasury bills. We have a treasury bills of 91 days, that is the shortest term. We have an horizon of 181 days, treasury bills, and 365. The longer the duration, the higher the return. So if you look at a treasury bill of 181 days, it pays a return that is slightly higher than a 91 treasury bill. A 365-day treasury bill will pay you a return that is higher than a 181 day and 91. So if you look at the money market fund benchmarks their interest with the shortest horizon of a treasury bill, which is the 91 days. So because the exchange, if you have invested in a money market fund and you want to withdraw, in exchange of another person who is coming in to invest, you exchange that money on a one-to-one basis. Because in a money market fund, you cannot talk of capital gain. But the instrument in the primary market, if one was to dispose, we will have the language of a capital gain, because you are selling a product. A money market fund, you will not be selling a product. You will buy a service. Another rationale is the economy of scale. There are advantages that come with investing huge amounts or huge sums of capital in the primary markets, especially when you look at in the bond market, in the primary market, a tax concession or a tax reduction is offered for investors that are investing huge amounts of money. And in most cases, it's a tune of 20 million. The fund manager is able to gather finances from many investors. Once they bring that money together, they are able to raise such amounts that will give them concessional tax reduction. So if the fund manager has invested 20 million, and instead of a withholding tax of 15%, they get to be taxed at 10%. They have already gained 5% in the direct income. But you, as an investor in a money market fund, you must be charged interest at 15%. You must be charged at 15%. However, there are some huge investors who would still want to invest through investment banks in these money market funds. Those ones are able to negotiate rates. But for majority of us, the small investors, you cannot negotiate because you lack the economies of scale in terms of amount. And therefore, you take the rates that are there and you are compulsorily mandatory 15% withholding tax will be applied. But the fund manager, because of the ability to source a huge amount for investment, they will get an advantage of a saving of 5% when it comes to that tax. Another scale comes in when you are bidding. When you are bidding in the primary market, we are categorized into two. There is the small investors and the corporate or big investors. If you are investing an amount that is more than 2 million, you are able to bid competitively. Competitive bidding means you are the one who chooses the rate of return or the interest rate that you want the government to pay you on that investment. If you are investing less than 2 million, you are compulsorily required to bid non-competitively. You are bidding at a zero interest rate, meaning that you are going to be paid at the average rate to be determined by the committee, the bidding committee or the selection committee of Central Bank upon examination and collection of the bidding after the auction. And that is the average that comes from the competitive bidders. Remember, the 29 money market fund managers, they know one another. they are able, men out of their experience and influence, they are able to know at the rates at which they are going to bid. So because the fund manager has sourced a pool of money, he has raised enough to bid competitively. Competitively meaning that he is likely to get an interest rate that is higher than the average rate that is being paid in the treasury bills. Because once the treasury bill is paying 14%, there are some investors who could be paid by the government 14.5, 15%, depending on the subscription or the bids that the government receives. So on that bidding advantage, bidding competitively, and the tax savings, already the fund manager, above the management fees that they will charge, they have already made money. And therefore, the fund is able to pay an interest rate that is equal to what the government is paying because they have already made their money. And that gives them a competitive advantage when it comes to sourcing of money with investors in the same market with the government. Another question. What advice do you give a person who is able to raise the minimum to invest in the treasury bills or in the primary market? And this is my take or my opinion. If you are not able to source or you are not able to raise enough money to get advantage or take advantage of the economies of scale in the primary market, I would advise go the route of the money market funds. And especially look at the top 5. And with the top 5, now you have the responsibility of analyzing each. I don't want to mention names. This is not a paid, it's not a paid live stream. I'm not championing or marketing either, but the top 5 for purposes of maximization, because until we become too wealthy, because our needs, remember, investing, saving has to be goal-based. There should be a purpose, a reason, a goal. For most small investors, our main reason for investing is to get interest, to grow our investment through interest. But mainly, it's the interest or the returns that we expect. And that is where many of us go wrong. Because you must define whether the investment is for the long term or is for the short term or immediate. Because if it is for the long term, that is the only time compounding gives you advantage. Short-term investments, you'll never enjoy compounding. Even if you're in a fund that sells on the basis of compounding. Short-term, in order to take advantage of compounding, there has to be time as a factor. Compounding is felt after a long period of time. Compounding only applies when we are talking about plowing back, reinvesting the return, not the amount that you are saving. Accumulation, because accumulation runs through the 3 phases that I've identified. You have a saving phase where you are accumulating, you are piling money, what many will call emergency funds. You are piling money throughout your investment journey. But compounding will be felt on long-term investments on the item of return. When you don't consume, the interest. You don't consume the dividend. You reinvest it. Compounding is when that interest or dividend forms part of your investment or principal such that it starts generating money for you. You get more foot soldiers, more money chasing and building money for you. Apart from what you are saving, the returns, if it is dividend, if it is interest, forms part of the money that is generating more money for you. And that means then, if you have invested in a vehicle, an opportunity that does not give you compounding automatically, meaning that unlike like many money market funds will talk of, they have daily compounding, monthly compounding. That essence comes in when you look at your investment account and your income account or your return account. They are combined. And I'll give you a good example with the treasury bills and treasury bonds. If you are going to purchase a treasury bill or a treasury bond directly from the central bank, the two accounts are split. If you look at your DAO CSD account, you get a portfolio account and an investment account. The portfolio account only shows you the instruments that you have bought. Then there is another account, the investment account, that shows you their valuation in terms of the monetary measure of that portfolio. But those are the investments that we have done. When it comes to a point of redemption or coupon payments, when the government is paying you interest, they don't put that interest in the investment account. That interest or the redeemed amount is wired back into your usual bank account, which you gave as your settlement account. So in essence, your investment account and your income account, which is the settlement account, they are separated. If the interest is once it is wired into your settlement account, if you don't access that money and bring it back to buy another bond or buy another treasury bill or bring it back to a money market fund because it has not met the threshold, the minimum amount to buy a treasury bill or a bond, then you have lost in compounding. Compounding will only happen when your interest, when your dividend, the returns are reinvested. So that comparing to a money market fund, your investment account is also your income account. So once the fund manager calculates your interest, it is paid into your investment account. So when you don't withdraw it, it will be available to the fund manager the following day for reinvestment. And that is what I'm calling compounding. Then we have interest is paid to a different account. We are supposed to take that into another investment. And the most available investment for those who have invested in bonds in the primary market is you take it to a money market fund, build it up until it's in you get an amount enough to go back to the primary market. On stocks, when you are paid your dividend, you take that dividend and purchase more shares or more stocks. You will have reinvested, and for that reason, you are taking advantage of compounding. On the elements, when it comes to compounding will be felt in the long term, not in the short term. The same way, in the short term, when you start your saving journey, depending on the amount that you have accumulated, at the saving stage, forget about interest or the return. Concentrate on the piling, the investing. Concentrate on the piling or the investing. If you concentrate on the return, which may be material, insignificant, so small, you will be discouraged and you are likely to pull out of that investment. That is better looked at when you look at circles. The main reason why many people who have throughout their life, their working life, been members in circles, immediately they retire, the very first thing that they think of is pulling out or withdrawing from their circle. And the reason why they pull out from the circle is that the amount of dividends and the interest rebates that they are expecting to be paid by the circle after every trading period, the totals, when they look at them, they are so small, immaterial, compared to what they think in their mind they can do with the amount that they have already saved. A person who has 300,000 worth of deposits in a circle that is paying a return of, let's say, 14%. If you take 14% of 300,000, that is 42,000. 42,000 in a whole year for a person who has available 300,000, most would say, that is amount is so small. They will think they can do better or get better returns if they access the 300,000, only for it to get squandered, because we invest in opportunities or vehicles that we understand. If you get the worst decision or the easiest way you are going to lose your money is when you make hasty investment decisions and put your money in opportunities that you hardly understand. But for a person, let's say, for example, was saved to a tune of 3 million. Throughout their saving life, this person has accumulated 3 million in a circle that is paying a return of 15%. It is easy to convince such a person, because they are getting in the neighborhood of 500,000. It's easy to convince such a person to continue with the investment and take advantage of the return. Once they receive their 500,000 as a dividend from the circle, they move it to a money market fund where they are going to be doing drawdowns. They will be accessing a specific amount every month as their passive income to live on. So it's a point of the return or amount of returns that you expect in investment is not a subject of the rate. It is a subject of the amount of capital that you have accumulated and invested. The mistake that most of us do, we look at the rate of return and forget about the object to that rate, which is the amount that you have saved over time. You should accumulate a sizable amount of capital that, when subjected to the rate, gives you an amount of income that you can divide by 12 to get a sizable monthly income that can support your lifestyle, that can cover your lifestyle expenses. That is the idea of financial freedom. That is the idea of financial independence. Accumulating capital, building of assets to build portfolios. A portfolio is simply a list of investments. If you have 4 bonds that you have purchased, that is a portfolio already. It's a portfolio of 4 instruments. So at the end of the day, the assets that you have accumulated, the investments that you have done, the returns that you are getting from those investments being enough to support all your expenses, that is the time you talk of freedom. A point in which your passive incomes have replaced your active incomes, or your passive incomes can comfortably support your lifestyle expenses and any other expenses. Because categorically, when you are categorizing at the point of when we say you have actualized in your wealth building, we will categorize your portfolios into 3 or 4 depending on your ambitions. We'll have the first portfolio, which you call a lifestyle portfolio, whose incomes should cater for your lifestyle expenses, your ordinary living expenses. Then we have another portfolio which we call a security portfolio, which is another level of investment that serves to cater for expenses that would otherwise disrupt your lifestyle portfolio. Things like medical care, things like education, such disruptors are taken care of by security portfolio. Then we have aspirational portfolio, things that would want, if it's a philanthropy and the like, things that would love to do passionately, they are taken care of by a different portfolio. You can also have legacy portfolios and others. So thank you friends, thank you brothers and sisters for listening or for watching the live stream. If I don't get other questions, I would love to close the live stream at that point. Thank you, Lebo. Thank you, Omar, Mos. And thank you for the 3 who are watching the live stream as at now. Thank you for your time. I'll see you tomorrow. Have a good night.